Welcome back everyone, and thank you for joining us today. What you're about to hear is a story that affects hundreds of thousands of British citizens living overseas, and yet, it's one that rarely makes the headlines. At the heart of this issue lies the state pension, a payment so many rely on after a lifetime of work. But for more than 1 million British pensioners living abroad, their retirement income could come with an unexpected sting in the tail, the risk of being taxed twice. According to the latest data from the Department for Work and Pensions, there are now well over 1 million British expats who continue to receive their UK state pension while living in another country. For many, this payment is a vital lifeline, ensuring they can meet basic costs, enjoy a modest standard of living, and maintain some financial stability in their later years. But new concerns have been raised that some of these pensioners could end up paying tax twice, once in the UK, and again in the country where they now live. The warning is stark. Official guidance from gov.uk confirms that in certain situations, expats can be hit with double taxation on their state pension. Imagine spending decades working hard in the UK, paying national insurance contributions, and building up your entitlement to the state pension. You finally reach retirement, perhaps choosing to move abroad to be closer to family, to enjoy better weather, or simply to make the most of your later years. You expect your pension to follow you wherever you go. And indeed, the payments do continue. But then you find out that while HMRC considers your pension taxable income in the UK, the government of your new home country may also apply tax rules of their own. The result? You could see a significant portion of your hard-earned pension swallowed up by two separate tax systems. This is what is known as double taxation. And for pensioners living overseas, it can be a devastating blow. The good news, however, is that in many cases there are ways to avoid it, or at the very least, to claim some of that money back. But whether you can depends entirely on where you live, or double taxation agreements exist between the country and the UK, and the size of your overall income. So how does this system work in practice? Let's break it down. When you receive your state pension, it is considered taxable income. Just like wages or other forms of income, it counts toward your annual total. In the UK, the tax-free threshold is known as the personal allowance. For the vast majority of people, that allowance currently stands at £12,570. This means you can receive up to £12,570 in income each year without paying any tax on it. But once your income rises above that amount, the taxman comes calling. For pensioners whose total annual income, whether from the state pension, private pensions, savings, or other sources, exceeds £12,570, tax begins to apply. And there are further complications for those with very high incomes. If you earn more than £100,000 a year, your personal allowance begins to shrink, decreasing by £1 for every £2 of income above the £100,000 threshold. By the time you reach £125,140 in annual income, your allowance disappears altogether. That means every single pound you earn is taxable. For expat pensioners, the problem is that their UK state pension can already push them close to or over the personal allowance. And if the country where they live also taxes pension income, they can find themselves hit twice. This isn't just theory, it's reality for many. But here's where some relief may come in. In most situations, pensioners can apply for what's called tax relief. This process allows you to claim back some or all of the tax you've paid in one country, provided that a double taxation agreement exists between that country and the UK. Double taxation agreements, often called DTAs, treaties signed between countries to make sure people don't end up paying tax twice on the same income. The UK has such agreements with many countries, from Australia to Spain, from Canada to the United States. But not every country has one. And even where agreements do exist, the rules vary. Some countries exempt UK pensions from local tax. Others require you to pay tax in one country first and then reclaim it in the other. So how do you claim this relief? The process is bureaucratic, but it can save you thousands over the course of your retirement. First, you usually need to apply for tax relief in the country where your pension originates, in this case, the UK. This means working with Revenue and Customs, the UK's tax authority. To do this, you'll need paperwork. In some countries, the local tax office will provide a specific form. In others, you may need to write a letter. Either way, you will need to prove your eligibility for tax relief. This often involves obtaining a UK certificate of residence, a document that confirms to the foreign tax authority that you are still considered a UK taxpayer. Once you have this certificate, the process continues. You either submit the completed form directly to HMRC, or you attach your certificate to a written application. HMRC then reviews your case, stamps their confirmation, and returns the paperwork to you. With that official confirmation in hand, you can forward it to the tax authority of the country where you now live. It's a long process. It can be frustrating. But for pensioners facing the real risk of double taxation, it can mean the difference between financial security and financial hardship. The question many are asking is this: does my country have a double taxation agreement with the UK? Unfortunately, not every nation does. Countries like the United States, Australia, Canada, and most of Europe do have agreements. But if you've moved to a country without such a treaty, then you may face a far tougher battle. And the reality is sobering. Many pensioners moved abroad decades ago, perhaps long before tax complications entered their minds. For some, language barriers, bureaucracy, and complex tax rules are overwhelming. For others, they simply didn't know this was even an issue until they began losing money each month. Imagine a retired couple who moved to Spain to enjoy the sun after a lifetime of work in the UK. They rely on their combined state pensions as their main income. Spain has a double taxation agreement with the UK, meaning they should be protected. But unless they go through the proper paperwork, their pensions could still be taxed twice, leaving them with far less than expected. Or think of a single pensioner in a country without a tax treaty, where they may have no recourse at all. This is why information is critical. Too many pensioners are left in the dark, unaware of the risks or the solutions. The government's own guidance is clear but not widely publicized. And so, every year, money that could be in pensioners' pockets ends up lost to tax systems on both sides of the border. It's also important to remember that while most pensions may be free from foreign tax, they are still subject to UK tax. That's why the onus is on individuals to apply for relief where applicable. The UK's network of double taxation agreements is designed to prevent unfairness, but the responsibility to claim falls heavily on the pensioner themselves. So where does this leave Britain's overseas pensioners in 2025? In many ways, at a crossroads. On the one hand, they remain entitled to their state pension, no matter where they live. That is an important principle of fairness after years of contributions. But on the other hand, the system is riddled with complexities that can cost them dearly if they don't know the rules. The message is clear. If you're a British pensioner living abroad, or if you have family members who are, it is essential to check whether your country has a double taxation agreement with the UK. It is equally important to take the necessary steps to apply for relief, to secure certificates of residence, and to make sure you are not paying tax twice on the same income. At a time when the cost of living is rising globally, when energy bills are straining households, and when every pound matters, losing out on pension money due to avoidable double taxation is a burden no one should face. The story of Britain's overseas pensioners is often overlooked. But as the number of retirees choosing to live abroad continues to grow, this issue will only become more pressing. Behind the statistics are real people, grandparents who moved closer to their children, retirees who sought better climates for their health, individuals who simply wanted to spend their final years in peace. They deserve clarity, fairness, and the full value of the pensions they worked a lifetime to earn. So let this serve as both a warning and a call to action. For expat pensioners, double taxation is a real threat, but it doesn't have to be a permanent one. By understanding the rules, seeking the right forms, and applying for relief, you can protect your income and ensure your retirement remains secure. And as always, we will continue to track updates from the DWP, HMRC, and government announcements to bring you the information you need. Because when it comes to your pension, knowledge is power and preparation is protection.